Hi, welcome to the low closing costs explanation video. This is for all the people who don't understand low closing costs and maybe the doubters, the haters, just the people who just don't get it. Maybe this will help. I'll try to keep it, I'll give you the short version, and then I'm going to actually make a separate video you can watch on my YouTube channel or on the website that is going to talk about just closing costs in general and explains them. Like it'll be about the three different boxes of closing costs. There's the bank closing costs, which is what we're going to talk about in this video. Then the other box is escrows, which is your or the borrower's own money, the borrower's own homeowner's insurance, the borrower's own property taxes, and maybe some prepaid interest for the month they close. So that would be the second box of escrows, and the third box would be government fees, which may or may not apply to a loan. So, but we'll get into that in a separate video. So this one is just going to be to explain how is it possible to have low closing costs. And the payoff to you is that at the end of this video, hopefully you're going to understand how it's done, why it's done. Then you're probably going to end up wondering why more banks aren't doing it this way. And you're probably going to be wondering why in the world would you want to pay exorbitant closing costs somewhere else from another bank or a mortgage shop when you're getting the exact same product and service, but you're paying a lot more for it. So you might be wondering that too. So here goes. So first of all, the low closing cost strategy, let's just tell a story. The two guys got together and wanted to start a bank, the bank that specializes in mortgages, and they said, we're going to do this a certain way. There's a certain way we want this to run, and we're going to run it right. And they had to compete against the low closing cost competitors way back in the day, over 35 years ago. So they always found it difficult to compete against low. They said we're gonna always have low closing costs. That's going to be our main strategy: is low closing costs, and it's going to be great rates, not low closing costs and high rates, or not low closing costs and try to hide that by jacking up the rate. No, it's going to be great rates all the time, and it's going to be low closing costs all the time. So that was the business strategy, and everything's built around that. So with that in mind, here's some of the ideas that support how this can work. Okay. It's not that complicated. If you just step back for a minute before I get into the banking, just think about business in general, not banking or lending, but just think about when Walmart came on the scene. There was a guy or an idea who took the very common concept of retailing and said, I'm going to be a retailer, but I'm going to do things a little bit differently, and I'm going to be the low-cost provider retail strategy. And so things were designed around that concept, and whether it was through inventory controls or whether it was through buying in bulk or however the strategy evolved, it became a powerhouse because people like to save money. And again, you're getting the exact same product at a better price. It became a powerhouse. Now, modern day, we can look at Amazon.com, very similar concept, that you can buy the exact same products from Amazon, sometimes at a better price. So again, it's different strategy, maybe cut out the middleman, maybe no bricks and mortar. So there are ways to be a low-cost provider, to provide the exact same product and the exact same or better service. So with that in mind, let's get into the banking part of being a low-cost provider. And so one thing you need to have is predicated around is high volume. So we need to have a lot of loans, or the low closing cost provider wants to have a lot of loans. So they're not making very much profit on the loans, but they're making, when they have more of them, then the profits can go up based on volume. So a little bit of money on every loan, but a lot of loans, and then you get your profits. So you could cut your fees, cut your costs, and basically not spend a lot of money on advertising. We all know that if you watch any sporting events or watch television, there's big national mortgage companies advertising on the Super Bowl, paying millions of dollars, or buying sports car advertising or what have you. And that's all fine. There's nothing wrong with that if that supports their business strategy. But if you take an opposite business strategy and say, we're not going to spend any money on marketing at all. What we're going to do is we're going to save people money. We're going to pay for their closing costs for them, all or most of them. In this case, most of their closing costs. And then we're going to ask for the word of mouth advertising. We're going to ask them to go out and tell everybody they know, friends, family, coworkers, about the company. So I guess if the big question is always lingering in the local, well, what's the catch? There's got to be a catch. Well, they're hiding it in there somewhere. Well, if there has to be a catch, if you have to say that there's a catch, then we're going to ask you to give us word of mouth advertising. I say we. I mean, it's the low closing cost, great rates lending model that is going to ask you to go out and say, hey, please tell people about us. Please send me people. Please send people our way. We can save them some money. And so that's, if there's a catch, that's the catch right there. Tell everybody you know. So with that in mind, high volume, understood. Another thing is, how about this? Local servicing. So how is local servicing going to help get low closing costs? Well, actually, local servicing, people love local servicing because that means that your loan won't be sold the very next day to somewhere in another state far away in California, or having people that can barely speak the English language properly to be calling them and finding out who's got your loan. It's confusing. You have questions. With local servicing, that actually supports the low closing costs, because there's a part of banking that you can gather up. Let's say you gather up a bunch of like $10 million worth of loans. You could actually sell off the paper, or really exchange the paper for more money to do more loans, but you retain the servicing rights. So as far as the customer knows, it's transparent. It doesn't matter whether the paper's in the bank vault or the paper's Fannie Mae has the paper and they gave you the money, but you still have the servicing rights. All the customer knows is that you're servicing their loan. So the low closing cost great rates model, in that model, with conventional loans, they're always serviced. The conventional loans are always serviced by that lending model. So borrowers love it too, but what people don't understand is you get paid to service those loans. There's small fees that come in to take care of those loans, to service those loans. So with the great rate, low cost closing cost lending model, you can see how you're getting paid to service the loan. Of course, you're making interest on the loan, and there's different ways to make profit. It's just not a big, huge chunk of closing costs up front like some of the mortgage shops have to charge, or the banks, the banksters. I like to call them the banksters. They can get away with it. They get away with all kinds of crazy things. If you watch the news, you can see how they're always trying to get away with things. The big national banks, and just charging people. Maybe they just think they can and get away with it. Maybe because you're doing business with them, and they know, they're not stupid. They know that 47% of the people don't shop around for a mortgage. So they say, well, we'll just gouge them for $2,000, $3,000 up front in closing costs, and they're not going to shop around. So just pure profit for the banksters. So anyway, so high volume local servicing is going to be how you can have low closing costs. And then also, just like any other, like I explained earlier with retailers, for example, we deal with third parties. Well, we can negotiate those fees with our third parties. We say to maybe it's a title company, there's certain title companies we maybe prefer to work with any of them, but maybe we'll go to some of the ones, or even appraisers, and we'll say, hey, you're a third party. We've got to pay you for your services to get these loans closed, but we'll negotiate. We'll give you a lot of volume. We'll keep you busy, but we're gonna pay you this much. Do you want it or not? And then so they build relationships, and maybe they can save a little money on some of those relationships. So again, working with your third-party people. And then two, there's one more thing about, just as a side note to this, people sometimes think, well, what happens? Loans don't go through, and you got to pay these appraisers. And so, yeah, the banks are very smart about it. They have the low closing cost model would say, hey, when we do your loan, we're not going to collect anything up front. We'll do your loan. We'll send you the government form that's required by law, the loan estimate. And after you get the loan estimate and see all the details of the interest rate and all the details about the loan, then and only then do you want to go forward. Is this correct? Do you want to go forward with the loan? Okay, if you do, yes. Okay, well then now we'll collect an application fee. Say, for example, it'd be a $250 application fee on a conventional loan. In that case, then if for any reason the loan didn't close, that would be the only amount of money that the borrower would have at risk is hey, I got my application fee. That's non-refundable. So if the loan doesn't close, that money, and the reason for that is that, again, bank can survive making a small amount of profit, but you don't want to lose money. So the appraiser still has to get paid. If he does the appraisal, or he or she does the appraisal, and that appraisal costs money, someone's got to pay that appraiser. So at least if something happens, maybe the appraisal comes in low, or the borrower changes his mind, or somebody backs out of a deal. It could happen occasionally, not a lot of times, but it can happen. But it can happen often enough where the bank's like, hey, at least we got that $250 application fee. Perhaps we could, cover the appraisal, or some of the appraisal, or most of the appraisal with that. So again, a little bit of a strategy there to really avoid losing money. I thought it was a side note worth mentioning, because it can kind of just help explain how some of those costs can be mitigated. And then last, I already mentioned it briefly, but ask for referrals. I mean, that's another way that you can have this philosophy of low closing costs. Is you're going to ask people for referrals, because the math is you're going to end up paying a lot of times on a conventional loan probably like $700 to $1,000 in actual real closing costs. And what are we talking about when we say bank closing costs? Well, that'll be in my other video, but just we can rattle it off. Talking about the appraisal, credit report, flood cert, title work. In the case of a purchase, buyer's title insurance. So it's all in there. It's all in there. Nothing's missed. Nothing's skipped. But if the bank could charge, for example, $450 plus recording fee on a purchase, well, that $450 is substantially lower than, $1,500, $2,500 or more, $3,000 perhaps. So that's a big savings. Or even better, on a refinance, if the low closing cost provider only charged $149 plus recording fee, well, that's just a tremendous savings. But you can see, hopefully you can see how it all works and why they can do that and how they can do that. So any questions? Again, I'll have another video you can watch on the Great Rates, Low Closing Cost, mortgage.com website, or you go to the YouTube channel and you can check out the one I mentioned earlier about the 3 boxes and kind of closing costs more explained in detail. Thank you.